Well, the old cliche about stocks is that they climb a wall of worry. And there have been plenty of things to worry about this year. And for the most part, the stock market has stayed true to the cliche. It kept on climbing. But in the past 24 hours, as U.S.-North Korea tensions heightened, the wall of worry got steeper. Too steep, in fact, for some investors. They pulled out of stocks today, continuing yesterday's late-day retreat, and moved ever so slightly into textbook safe havens like gold and bonds. The moves were not big. There was no panic selling. But North Korea is on investors' radar now, and as one strategist put it, geopolitics is splashing some cold water on the markets. Today, the Dow Jones Industrial Average dropped 36 to 22,048. NASDAQ fell 18. The S&P 500 was off a fraction. Earnings had been the focus of the market for some time, and while they are still very important, investors are also paying attention to some bigger, broader issues. Bob Pisani explains.
Here's a rare event. The stock market dropped today, largely on concerns about North Korea, but also partly on a spate of poor earnings. So far this summer, it's been a Teflon market. Nothing has altered the slow upward course of stocks. Is today's action just a blip, or is the market finally shifting focus? For the moment, the market seems to believe that the risks that this will elevate into a full-blown crisis are small. The major industries were down only fractionally, and measures of market fear and volatility were only slightly elevated. So, North Korea, the problem is not the only big issue. Congress has to authorize an increase in the debt ceiling when it returns from its recess in September. Raising the debt ceiling is not necessarily a big issue. It's been done before. But it's more complicated this time because there's a good chance Congress won't pass a clean bill that just raises the debt ceiling. They might pass a bill with all sorts of conditions on it that will create a political stalemate. That's a problem. If the debt ceiling is not raised, there's a small but significant possibility the U.S. Treasury could default on its debts. Even without default, a long fight over raising the debt ceiling is a bad idea. This happened in 2011. A similar fight led Standard & Poor's to downgrade the credit rating of the United States. That proved to be very costly. Raising the debt ceiling is, by the way, distinct from adopting a U.S. budget, and that too has to be addressed right after the debt ceiling issue. But conservatives are already demanding cuts in the budget, and if they don't get assurances that cuts will be forthcoming, they may not support raising the debt ceiling. You see, it's all a complicated mess, and it makes forecasting the stock market moves in the fall a lot more difficult than it normally would be. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.